So thank you first to Paolo and the Swiss Finance Institute for the invitation. So as mentioned by Paolo, my speech today is about risk-based investing, which is a topic which is close to the factor investing topic. And in fact, they interact in some way. But here, as mentioned by Paolo, we'll be only looking at the risk. So that's only related to the portfolio construction. And as mentioned this morning by Florian Herzog, I mean, portfolio construction is something overlooked by investors. It's probably one key aspect for the end result they will get. So my talk is about reviewing the academic research, but also show a little bit of the challenges for the practitioner and how recent research tried to mitigate those problems and how we do that in practice. So the first thing is that risk-based investing is popular. Maybe not as popular factor, it depends on the periods and what you look at Google Trend, but it's a fairly popular topic as well. So the reason why is, as already mentioned, right? So we are living in a world where basically expected return on traditional assets are going lower. In the same time, we're seeing already some evidence of higher risk, right? And the problem with that is that the general approach, general portfolio that investors will hold are not well prepared for that, because in general, they will be either very concentrated in risk. So for instance, here you have the typical example of a balanced portfolio. So balance in capital, like here between bonds and equity, and you will see that all the risk, mostly of the portfolio, is coming from equity, which means that equity will determine the performance of that portfolio. But you also see in general that you have some form of undesired risk in your portfolio. So factor investing is one way to deal with that, but obviously risk-based will be another way. So quite rapidly, what is risk-based investing? So I try to articulate the taxonomy. So basically, it's the principle of managing your portfolio solely on the basis of the risk, right? So there is, and I will be back on that, there is no expected return hypothesis, meaning that you don't need to have a strong view of whether bonds will be doing better than equities and so on and so forth, at least as a starting point. But basically, you try to maintain the level of risk or the composition of risk. And indeed, there are two components to that. That first of all, what I call here the risk weighting, which is the composition of the risk. So how much risk you want to have in equities, in bonds, how much risk you want to have in value stocks versus momentum stocks, and so on and so forth, right? But another dimension is what I call here risk targeting, which will be basically maintaining a level of risk over time, right? Which is another way to manage your portfolio, right? So here's an example for the first part, the composition of risk. So the most popular method in the academic literature, but also in practice, so will be minimum variance, maximum diversification, equal risk contribution, also known as risk parity, equal weight as well, which is shown as a stronger risk-based approach. And all of them will have different objectives, but they all belong to that family of risk-based investing. The second example is risk targeting, right? So let's achieve a strategy which basically try to be only exposed to the equity market, but rather than always be invested in equity market, you want to maintain over time a predefined level of risk. So an example here, I'm using, I guess, a 50% volatility target. And you see that to maintain the risk over time, then obviously you need to reduce the allocation. Here, 100% will be fully invested. So you're reducing your allocation when risk is very high, like 2008, and then you're back and increasing. And this way, by and large, you can achieve some higher Sharpe ratio, right? So some reduced drawdown for the same level of risk. So these are typical example of what is discussed in the risk-based investing literature. So what academia is thinking about it? So as mentioned by Paolo, and I refer to his research, some of the research I'm putting as a reference, and also the one from Spiros Merzomeris at Deutsche Bank, so as well, or other at UBS as well, because that's a topic which is well covered in academia and also by banks. So there is a form of consensus that risk-based investing is a stronger portfolio construction than the usual one that we all learn at school, which is mean variance optimization, Markovits-like. if you're doing Markowitz exercise, the simplest one, as a practitioner, you will be fairly frustrated because the portfolio you will end up will not be very credible to you. It will be too concentrated, it will be unstable over time, so then you put in constraints, and at the end of the day, these are the constraints which are determining the results. So that's not really useful, right? At the opposite, risk-based approaches seems to look to lead to portfolio which are credible, which are fairly robust over time, and which seems to be, at least empirically, some very good result. There's still some debate whether that the theory is strong or not, but the reality is that academia seems to be, and practitioners alike, seems to be, research in banks, for instance, are thinking that's interesting. The problem with that is, obviously, always from theory to practice, there are a few aspects. And in practice, as already mentioned by Paolo, there are a few questions that are raised by investors when it comes to risk-based investing. They will say there are a few aspects which sounds to be a problem to invest. So my talk is about reviewing a few of them, which are the most significant problems frequently raised by investors. First of all, and I will show how, in practice, this is dealt in the academic literature to some extent, but also how it needs to be dealt in real life, in order notably to mitigate part of the issue that you might have with, let's call it a naive approach to risk-based investing. Okay? So these are the three main myths that we'll cover. There are a few others, but in our own practice, these are the most important ones. So the first one is risk-based investing means necessarily being low-risk investing, or I will call it differently in practice. I will call it risk-based investing is all the same, right? So all the approaches, I show you already different approaches. That's a fairly large thing. And in practice, whether they are the same. In practice, and where is coming from, that myth? So the thing is that what is disturbing is risk-based. So if you say to something, I'm doing risk-based investing, this means that I'm taking care of risk, and probably nobody wants to increase the risk. Most of us would like to reduce it, right? So maybe. So that's why people are always expecting a risk-based approach to reduce the risk. And also, it's coming, that thing, from the fact that the pioneer strategy, both in academia, but also more importantly in practice, is minimum variance, which is in general associated to substantial risk reduction, right? So that's why it's coming from that. Our point here is that this is a myth in the sense that not all approach will be about reducing risk. Some of them try to diversify it, right? And by itself, it means nothing. For instance, if I'm telling you, well, you know, I want to have a portfolio which has a 10% risk, right? If I'm an equity manager, that's a fairly defensive portfolio. If I'm a multi-asset manager, then maybe it's a fairly aggressive portfolio, which might require leverage, I don't know, right? So it really means nothing to say there is one single approach to it. In the same way, like in factors, for instance, value means many things. You can build that in different way. So it's the same with risk-based investing. Just to illustrate how different the thing can be, is so here I'm using the most popular approaches I was describing, like equal weight, minimum variance, maximum diversification, and equal risk contribution. I'm using a database which is very well known by academics, which are the famous Kenneth French database used by Farmer French, notably. And basically, and I'm doing something very simple, right? So a simple variance covariance metric. I just apply the methodology and just look at what are the results, right? So in practice, that will be more sophisticated than that, obviously. But what you can already see is that those approaches, which are all of them risk-based, that's the allocation to the different sectors, right? So there are 10 sectors. You can see how different they can be in the allocation. Nothing related. So equal weight will be invested at any point in time in all the sectors. ERC will move a bit depending on the risk. Minimum variance will be moving much more, maximum diversification as well, and you can already see with the colors, they're not invested in the same sectors, right? So, for instance, minimum variance will like low volatility sectors, like utilities, consumers, non-durables. Maximum diversification prefer low correlation, which means, for instance, here, energy. So they are very different, right, in terms of what they are. But, well, how different they are in practice in risk as well? Well, if you look at that, then you can see the risk reduction. ex post or also ex ante is very, very different from one approach to the other. It could be volatility or drawdown. They are very, very different. So as the extreme, for instance, you will have the equal weight where the risk reduction is not great or is not huge. So other advantages will be the diversification of it, but minimum variance will be more spectacular in that regard. So it really depends on what you want to do. So whether risk-based investing means low risk, not necessarily. It depends on the objective of the methodology. This is not to say this is good or bad methodology. It really depends on the objective, right? But to answer to the question of Paulo, whether it's possible to reduce risk in practice, yes, it is. So as example here, so we have a realized performance on different universe, emerging, world equity, Europe. These are, these are realized return. And so as you can see, so here you have the volatility and here the returns, and here you have the standard market cap index, and you can see the risk can be reduced quite always, right? So quite significantly. And the good news for you, Paolo, is that does not necessarily mean lower return, right? So notably by targeting the risk, or at least achieving a risk reduction consistently over time, then because markets, when you're going down a little bit less by the compounding effect, the fact that you accumulate less losses, then you can achieve better return in the long run, right? So first myth, so risk-based investing, like factor investing, is not as simple, as not to say it's not one simple approach. It's different approaches. You need to understand in practice what are the differences and understand what are your objectives and whether one methodology or not will fit it, right? But yes, you can reduce risk and have good return as well. The second one, and in fact, I should have started with this one, right? So if, well, basically, I did not offer you the opportunity to raise your hand, but maybe if I had, so probably there will be already some of you will have been asking me, well, Jérôme, okay, but what does it mean risk, right? And risk, if you're going to a value investor, you say, well, there's volatility, we say, well, you're crazy or what? Risk means valuation and so on and so forth. So the second myth is that risk-based investing means only volatility. So, and where this myth is coming from, it's coming from the fact that in practice, for easiness, both academics and practitioners will tend, most of them, to use volatility, right? Because that's easier to handle, that's simpler to calculate, that's simpler to aggregate across the asset and so on and so forth. But in practice, if you look at the theory, there is nothing which is telling you that risk, for risk-based investing to exist, that risk shall be volatility. In fact, you need to have a mathematical property which is called, which is related to the decomposition, which basically said that you only need to be able to take the risk of the portfolio and break it down to the different components, right? So they're adding up, right? So it makes sense. And in fact, this property, mathematical property, is shared by many risk measures, right? So, and this is not only the volatility, but some other. What is interesting with this is that by taking a broader risk measure than only volatility, like an extreme risk measure, then you can incorporate other dimensions of risk quite easily. You can incorporate valuation aspect, you can incorporate asymmetry of risk, you can incorporate illiquidity of risk, right? So you can do risk-based investing and not only be restricted to volatility. So I'm coming to the practice, right? How we try to benefit from that in practice. The first example is fixed income. So we have very low interest rate in Switzerland, even negative. We also had that in other places of the world. Notably, we had that experience in Japan for years and years and years. One of the characteristics of Japanese government bonds is not that they have been posting zero returns since we entered into the zero interest rate policy. They have been posting some return, but the real problem you have with them is that you have a negative asymmetry in the return, right? So you're earning most of the time some return, and from time to time you have a big loss, right? It makes sense. If your interest rate is at zero, you will not earn a lot, right? Or at 0.5, like for instance currently on the bonds. You will not earn a big return, but it could be quite consistent. That's still fixed income in some form, right? But from time to time, you will suffer a big loss, right? That asymmetry cannot be handled by volatility. And for instance, you might remember the bond tantrum last spring, right? It did happen at a time when the volatility of the bonds, being implied volatility, realized volatility, was the lowest ever, right? So it was just close to the catastrophe. We know this is always very close to the storm when you have such a calm world, but that did happen. by using a broader risk measure than only the volatility, you can incorporate data symmetry, right? Holding bonds at zero interest rate, that's a risk for the investor because you can lose more than what you can earn, right? So that's possible to enter that. And indeed, I'm showing you just some calculation we made with a broader model that we use, right? So basically, we estimate that a 0% yield bond will have basically 3 or 4 times the risk of a 5% yield bond with exactly the same volatility, right? So that makes a difference. And that makes a difference for the way you manage your portfolio. A second example of application of this is, imagine you're a CIO of a pension fund. You have to allocate to liquid and illiquid assets, right? And for this, we know that for illiquid assets, volatility is probably not the right measure, right? So, because there will be some smoothing or return, right? So then no transaction every day. So that's a big problem. So in practice, by having larger, there are some research development which are offering again to incorporate larger set of risk measure in the models, right? So, and indeed, we do an application like this, right? So on a multi-asset portfolio made of traditional and alternative assets. What is interesting is that what we try to do here, so you have equity, small cap, investment grade, high yield, commodity, hedge fund, private equity, real estate. Okay, big list, right? Very typical of your asset allocation. What we try to achieve here, the bars are showing you the risk, the contribution of risk of each of them, and they're all similar, right? Because this is what we try to do. We want to build a portfolio where all the assets will contribute to the same extent to the risk of the portfolio, right? Think about a form of risk parity in that regard. But what is interesting is that we look at the contribution of the different dimension of risk, right? And for instance, the pink bar, the pink section is representing the volatility risk. So the portfolio, this is the last one here, is dominated by volatility, but volatility is coming mainly because you are holding equity, listed equity. At the opposite, if you're looking at real estate, the contribution to the volatility of the portfolio of real estate is zero. But real estate is contributing to the illiquidity of the portfolio, right? So this means that if you want, you can pick a little bit the risk you want to hold. If you have a longer reason, you could say, well, you know, I don't care about illiquidity risk, so I can increase that bar, and then obviously the allocation will change, right? If you remember the asymmetry I was referring to, the skewness, so for instance, corporates bond will be very asymmetric, right? So they're contributing here. Here again, you can adapt your portfolio. Okay, and but we saw that volatility probably means something for equity, but even for equity, we have discovered that, that basically only looking at volatility correlation is probably too limited, right? And indeed, we just map here all the risks that we look at when we build risk-based portfolio in equity. Think about valuation, fundamental ESG, carbon, or things like that. But one of the very important topics at the moment, you probably, if you're familiar with this, you probably noticed that minimum variance portfolio in general, low-risk portfolio in equity have been doing very, very well, right? But the problem for some investors is that they're starting to become maybe expensive, right? And here we're showing, basically the green bar is the price-earning ratio of a traditional minimum variance portfolio, right? As will come out of the optimizer, right? And you see it's becoming very expensive. The price-earning ratio is 30, right? Where the market will be at 20 or a little bit less than 20, right? By controlling that, in fact, we are changing, by controlling that and other risk, right? A broader set of risks than the pure volatility. Indeed, we are, first of all, changing the profile in practice. So that's the pure optimizer. That's the reality of what we do. And this is the traditional benchmark. But we can also maintain something where basically we're not more expensive than the market, in practice even less expensive, right? So you can look at the risk from different angles. Only looking at volatility, then you're very expensive. Controlling the different dimension of risk, then you can achieve significant reduction in risk, right, in volatility, but have something which have less risk from other dimensions. And finally, the last myth I will review here, it's a bit related to this, it's about risk-based investing means you're agnostic, you have no view, right? So I'm just controlling the risk, I don't care about the future, and this is presented this way. In fact, so it's coming from read the math or the theory, if I can say about it, of basically a minimum variance portfolio, for instance, is Markowitz without expected return hypothesis. But that's a key problem for investors, to be agnostic, right? So do you want to have your asset manager saying, well, I'm agnostic, I have no view, you know, I don't think it is, there is anything to say. Well, so we have seen the problem of lower risk investing in equity and expensive net stock. Another big problem, non-problem is multi-asset risk parity, with the fact that interest rates are low, right? And the fact that in general they will hold more bonds than, let's say, other portfolio, right? And that's a problem for investors. In fact, our point of view is that this is a mistake to consider that necessarily a risk-based approach shall have no view. Here again, there are some research development that combine risk-based investing with views, and basically you can add a dynamic allocation on top of the strategic portfolio. Risk-based portfolio is a strategic one for the long run, and you had some views. So just to give you an example, multi-asset risk parity is based on the premise that over the long run, you have here the Sharpe ratio of different assets, bonds, world, commodities, and we also had some alternative risk premia like FX carry and trend following, right? Over the long run, most of them will have similar Sharpe ratio, right? So that's full sample over the last 40 years or so, they have the same Sharpe ratio. In that regard, the optimal portfolio is the risk parity one. But in practice, you see that during economic regime, obviously, you will see some changes. And for instance, during recession, government bonds are doing okay, trend following is doing okay, but equity obviously are not doing well, commodities are not doing well, and so on and so forth, right? If you're only doing a risk parity on equal risk contribution, then your portfolio will probably be doing very well in the long run, but in the shorter term, it can be really affected by this, right? So, and that's a problem, because maybe you're holding commodity for the very long run because you think there will be an inflation shock, but if you believe that you're in a deflationary environment very short term, it's a little bit a problem not to consider that aspect. If you're convinced about that, or if you have strong evidence about that, why to buy commodities where you're really convinced they will never pay off in that environment? So we can combine both, use Black-Litterman adaptation to the risk-based approach, right? So, and basically, I will show you how we're doing that. So basically, we monitor the macro risk, right? And the market risk as well, and we adapt the risk-diversified portfolio, the risk-managed portfolio to this. So in practice, it shows you how, notably during market downturns, that will allow us to, in general, achieve some outperformance. So that's dynamic allocation contribution relatively to the strategic portfolio. So adding some value by just monitoring the risk. It's difficult to forecast, right, what will be the regime, but at least you can try to adapt to where you're standing in the business cycle. And this is what we do in practice. So as a sum up, so yes, risk-based investing is popular for good reason. That's part of the with factor investing. That's part of really of the thing you have to consider in order to have better chance to achieve your results in current challenges, right? In low interest rate, notably as an example. But a pitfall in practice, like always, the devil is in the detail. So it's really important to consider the differences. It's really important to have experience around that. And as mentioned by Paolo, I mean, we call that some form of active risk-based investing is really important to have. Thank you.
Please, if there are questions to Jérôme Teïletche, please ask.
Thanks. You touched on the very topical question regarding the bonds that probably everyone is interested in, that bonds are less attractive with falling yields in a falling yield environment. Is there actually data that can show that the relative downside volatility increases as the yield goes down? This question just arises. You mentioned the Japanese government bond since years, but at times it's been a massive contributor of returns. And is there data that one can look at that actually really shows the downside relatively increases when we have a lower yield on an interest-bearing instrument?
Yeah, that's a very good question. So that one not basically seen on the volatility. I've not been looking at downside volatility, but probably that's part of the result, where it's really clear. That's a research that I wrote last year on the topic before the Bund, precise it, the story. It was in The Economist. And basically that's, you see here the asymmetry. So not looking at downside volatility, but looking at the skewness, right? You see that Japanese government bonds have a very negative skewness, right? Here you have the skewness on the negative side and positive side. So, for instance, sorry, US Treasury, for instance, will be positively skewed, which is good for the investor, positive asymmetry in your favor. But the opposite, Japanese government bonds, will be very skewed. So you're right, they achieve good results over the last 20 years or so, but they are very negatively strong asymmetry, right? So this means that basically you're earning some return, like basically selling a put on the market, you're earning a bit of the coupon, even if it is low, but it's quite consistent, but from time to time, you have a big loss because the market does overreact. So statistically, this is how you can see. And if you're interested, in fact, I wrote a few equations, so we can show this is related to the fact that there is a floor, right? We don't know where the floor is. Maybe it's at where the central bank will put the floor, right? Because here in Switzerland, we have a negative interest rate, and now we even have in Japanese, right? So probably the floor is where the central bank is putting the short-term interest rate, but there is a floor. If you have an asset, even if it is normally distributed, and you have a floor, basically you can, on the interest rate, so basically what you can achieve as a return will be fairly limited and your loss is very large, right? So it's very asymmetric. A bit like a corporate bond holding to maturity. If there is no default, then you get your coupon, and if you have a default, then you have a big loss. That's a fairly kind of exercise. So yes, you can incorporate that. So bottom line, it did help us not being too exposed to the Bund because you can model the skewness depending on the level of interest rate, right? The skewness will be more negative in that case.
So one question. Tom, you have to tell us whether you're invested in risk factors, by the way.
I'm a retail investor. It's hard. How do you think people can use risk-based approach if they don't want to change their whole portfolio? How can you be incremental in moving to this approach?
So that's really different from. That's a very good question. That's very different from what you do. If you think about multi-asset approach like risk parity, obviously this means that that you have to go, in theory, you should have to go fully to it, right? The practice we saw was that exactly as what you were describing. It was more kind of in a flexible bucket, absolute return, where investors have been putting those approaches, right? The problem will be different from some approaches in equity, like if you apply that to an equity, like minimum variance, maximum diversification, then you have a result, you have your equity bucket, and you replace. As an example, really, our own experience with equity is that basically the investor will replace the normal equity portfolio with such kind of an approach, or even they will allocate more to the equity, which makes sense at the current time because with the same risk budget, you can, because you're reducing the risk, you can invest more in equity, which sounds appealing when you see the interest rate at the moment, right? So it really depends on where you apply that. But the reality, as you mentioned, with few exceptions, we see it's more in general still by building block rather than totally changing. But this being said, some of them have been doing it, but yeah, that's more by step. As you mentioned, there's probably some carry risk as well for investors to go fully to risk-based investing.
Do you offer these mostly for institutional investors, so mostly mandates for pension funds, or is there also some funds that are dedicated for retail investors?
Well, all of them, I would say. So funds can be bought by investors and institutional investors and retail investors for distributors. So our own clientele at Unigestion is mostly institutional, right? So, but for instance, something which is developing quite fast. So we have been doing multi-asset risk-based investing. I was not there, but I joined recently, as you mentioned. But for more private wealth segment for quite a long time, right? And in the UK, for instance, there is a strong development in an offer for retail investor of a risk-aware or risk-target portfolio, which will be probably a little bit related to those investments, right? So we see that that's something which is coming broader. I guess with the ETF, as mentioned, that's probably something also that's also attractive for retail investors. So that's fairly broad. There are some approaches which are easier to understand than others. I will say this. So, for instance, if you reduce the risk, if you're targeting to reduce the risk and you achieve that quite consistently, that's fairly easy for people to understand. It works, right? If your objective is more to diversify the risk, so what will be the outcome of it? It might be a little bit more complex to evaluate the result. So I think that's part of it. But that's gaining traction not only in institution but also retail.
So you mentioned at the beginning that there is a relation between risk-based investment and factor investing.
Yeah, very good question. But that's I think that the relationship is coming from different angle. So if I start from the world of risk-based investing, those methodology then, by allocating differently to the sectors, they're allocating to the stocks, right? Will allocate differently to some factors, right? So for instance, equal weight will be known to have some small cap exposure, right, relatively to a market cap. Or maybe a more defensive approach will be going more into low risk or quality. We know that the minimum variance portfolio are very well exposed to quality stocks and so on and so forth. So implicitly you have factor exposure. But in practice, we also combine, and we recently launched with a public pension that's public, so I can tell it some strategy which are combining factor approaches in equity, but also with risk-based portfolio construction. So there are two dimensions, I will say. One is the selection of the stocks or the asset. The other dimension will be the portfolio construction, right? So both can combine themselves. So there are two segments which are complementary.